Ever feel like understanding the stock market is like trying to, well, decipher secret code?
Uh-huh.
Today, we're basically handing you the decoder ring, and it's specifically tailored to these excerpts you shared from a chapter on stock investing.
Right. And our mission in this deep dive is, to really pull out the essential stuff about investing in stocks,
Okay.
what they are, how you navigate the risks, because there are risks, and some effective ways to evaluate them.
So getting to the core principles without all the overwhelming jargon.
Exactly. We want you to walk away with a solid, insightful understanding.
Okay, let's jump right in then. The source material starts by laying out the fundamental difference between equity and debt. Can you break that down for us? Make it stick.
Absolutely. So imagine you're helping a friend start a business, right?
Yeah.
If you give them a loan, that's like debt. They have a legal obligation, a contract to pay you back, usually with interest.
Okay, straightforward.
Now, equity,
Yeah.
that's different. If instead you become a part owner, you buy a share, that's equity. You get to share in the profits, hopefully,
Hopefully, yes.
but also the losses. And you have a claim on the company's assets, but only after all the debts are settled. That's what we mean by a residual claim.
Ah, okay. Residual meaning what's left over.
Precisely, the leftovers.
So unlike that loan to my friend, buying stock doesn't mean the company has to pay me back. Or give me regular income, like interest payments.
That's exactly right. There's no contractual guarantee.
Mm-hmm.
Companies aren't obligated to return your initial investment or even to pay dividends regularly.
Right.
Now, the hope is for capital appreciation, the stock price going up, and maybe some dividend income. But neither is guaranteed. Dividends depend on profits and board decisions and price increases. Well, that depends on the market.
That definitely sounds like it carries more risk than just lending money. Is that the core trade-off here?
That's the fundamental trade-off the source highlights: risk versus potential return. Generally, lower risk things like, say, high-quality bonds tend to offer more stability, but maybe lower returns over time.
That makes sense.
Equities, stocks, they have a higher risk profile. But with that comes the potential for greater returns. Also, the potential for greater losses. We have to remember that.
So investors need to balance that.
Yeah, many investors manage this by splitting their money between different asset classes, based on how much risk they're comfortable with and how long they plan to invest.
Right, that makes sense. Okay, so risk is inherent. The source then talks about managing that risk, and diversification comes up as a key strategy. What are the main ways to diversify?
Good question. The source points out two really crucial ways. First, there's what's called cross-sectional diversification.
Cross-sectional.
Yeah, it means spreading your investments across different companies in different industries, maybe in different countries, all at the same point in time.
Ah, the old don't put all your eggs in one basket idea.
Exactly that. Because different sectors and economies don't always move up and down together, right? So if one area hits a rough patch, having investments elsewhere can cushion the blow.
Is there a limit to how much that helps?
Interestingly, yes. Research suggests that once you have a certain number of well-chosen stocks that aren't too closely related, maybe around 20 or 30, adding even more doesn't reduce risk that much further. It's about smart diversification.
Not just collecting stocks randomly.
Right. And the second type is time series diversification.
Investing over time.
Yes, exactly. This focuses on when you invest. It's the strategy of investing consistently over a long period, drip feeding your money in, maybe?
Yeah. Rather than trying to guess the perfect moment.
Precisely. Instead of one big lump sum or trying to time the market highs and lows, which is, let's be honest, incredibly difficult to do consistently. The idea is that over the long haul, the bad times, the downturns, they'll likely get canceled out by the good times.
So time in the market beats timing the market.
That's what the source emphasizes, and it's generally very sound advice.
Now, the source also briefly mentions business cycles and counter-cyclical businesses, referencing a figure 8.1. What's the gist there?
Yeah, it touches on how different parts of the economy react to the natural ups and downs, the business cycle.
Expansions and contractions.
Right. Some industries are called counter-cyclical or defensive. Think about things people need regardless of the economy, like basic food, healthcare, utilities. These tend to hold up relatively well even when the broader economy slows down.
So they might do okay, even in a recession.
Potentially, yes. The figure probably showed that kind of inverse relationship. The source also hints that different sectors, even different countries, might lead or lag during these cycles, which ties back into why diversification across sectors and geographies is important.
Okay, so diversification across companies and sectors, and also over time. Got it. Now let's break down the specific types of risks the source mentions. First up, market risk.
Right, market risk, also called systematic risk. This is the big one, the risk that affects pretty much the entire market, or at least large parts of it.
Like what?
Things like changes in interest rates, overall economic slowdowns, inflation spikes, geopolitical events, stuff that hits almost all stocks to some degree.
And you can't diversify this away.
Not completely, no, because it affects everything. The source mentions beta as a measure of how sensitive a particular stock is to these broad market movements. A high beta stock swings more wildly than the market. A low beta stock is more stable.
But you can't eliminate it just by buying lots of different stocks.
Correct. You can try to hedge against it using other financial tools, but diversification within stocks won't make market risk disappear.
Okay. Now, does sector-specific risk? How's that different?
Sector-specific risk, or idiosyncratic risk, is risk unique to a particular industry. The source used a good example. Maybe new regulations hit the banking sector hard.
Right.
Well, banks would suffer, but maybe tech companies or retailers wouldn't be directly affected much at all.
So this is where diversification helps more directly.
Exactly. By investing across different sectors that aren't closely linked, you can reduce the impact if one specific industry runs into trouble.
Then there's company-specific risk. Similar idea.
Very similar, but even more granular. This is also idiosyncratic risk, but it's specific to just one company. Maybe bad management decisions, a product failure, a major lawsuit.
So even in a healthy industry, one company might stumble.
Precisely. And again, diversification is your friend here. Owning shares in several different companies within a sector or across sectors means one company's bad news won't sink your whole portfolio.
Makes sense. What about transactional risk? That sounds like risk in the actual trade.
It is. It's the risk that the other party in your trade won't fulfill their end of the bargain. Maybe they don't deliver the shares you paid for, or they don't pay for the shares you sold.
Does that happen often?
Thankfully, it's rare in major markets today. Stock exchanges have really robust clearing and settlement systems designed specifically to minimize this risk. They act as intermediaries.
Okay, good to know. Then liquidity risk. What's that?
Liquidity risk is about being able to buy or sell a stock quickly without significantly impacting its price. Can you get in or out easily at a fair price when you want to?
And some stocks are harder to trade than others.
Definitely. The source introduces impact cost here. If the stock is thinly traded, meaning not many shares change hands regularly, even a modest buy or sell order can cause the price to jump or fall quite a bit. That's a high impact cost.
Like trying to sell something very niche versus something common.
Good analogy. Highly liquid stocks, like those of large, well-known companies, have lots of buyers and sellers, so you can usually trade them easily with low impact cost.
And finally, currency risk. When does that come into play?
Currency risk affects you if you invest internationally. If you buy shares in a European company, say, your investment is in euros. When you eventually sell and convert those euros back to your home currency, say US dollars, the exchange rate fluctuation could either boost or hurt your overall return.
So it's an extra layer of uncertainty for international investments.
It is. And the source rightly links this back to broader macroeconomic factors, too. Things like inflation, interest rates, economic growth in different countries.
Yeah.
They all influence exchange rates and the performance of international stock markets.
Okay, that's a really clear picture of the different risks. The source then gives an overview of the equity market. What are the key points there?
It mainly reinforces that equity means ownership, a claim on a company's net assets. And the global stock market is just huge, offering this vast range of choices.
Choices in terms of risk and return.
Exactly. Risk, potential return, liquidity. You can find investments across the whole spectrum. And it's not just about the big listed companies on the major exchanges like the NYSE or NASDAQ.
There's more.
Yeah. There's also the unlisted or private equity space, though that usually involves less liquidity, different regulations, and is often inaccessible to smaller investors.
Okay, so given this huge array of choices, the next section stresses the importance of equity research and stock selection. We can't just pick randomly, right?
Definitely not advisable if you want consistent results. With thousands of stocks out there, you need a process. Equity research is that systematic process.
What does it involve?
It involves analyzing companies, looking at their financials, their management, their position in the industry, their competitors, the broader economic environment. All of it.
And the goal?
The ultimate goal is to estimate what a stock is truly worth, its intrinsic value, and then compare that to its current market price.
To decide whether to buy, sell, or hold.
Precisely. Analysts use different frameworks, like fundamental analysis, which we'll get into, and also technical analysis.
Okay, let's dig into fundamental analysis first. What's the core idea?
Fundamental analysis is all about figuring out that intrinsic value. It looks at the underlying economic and financial factors, the fundamentals that determine a company's worth.
Like what kind of factors?
Things like its future earnings potential, its expected cash flows, the current level of interest rates, the risks the business faces, all the core economic drivers.
And the belief is that the market price will eventually reflect this true value.
That's the central belief. The market price might bounce around in the short term due to sentiment or noise, but fundamental analysts believe that over the long run, price converges with intrinsic value. So find a stock trading below its intrinsic value, and you've potentially found a bargain.
The source mentions two main approaches, top-down and bottom-up. How do they differ?
They differ in where they start the analysis. Top-down starts big picture. Look at the overall economy first. Where are we in the business cycle? What are the macro trends?
Then narrow it down.
Exactly. From the economy, you identify promising industries or sectors. Then within those sectors, you look for the best individual companies. Think zooming in on a map.
And bottom-up.
That's the reverse. Start with individual companies. Analyze their specific strengths, weaknesses, management, products. Really get under the hood.
And then look outwards.
Right. After analyzing the company, you consider its industry and then the broader economic context. Both approaches aim for a deep understanding, just from different starting points. The source mentions the EIC framework: economy, industry, company, covering the key elements.
Okay, let's break down that EIC framework first. Economy analysis. How does the macro picture affect stocks?
Hugely. The overall economic health influences pretty much all industries and companies. Government actions play a big role here too.
Like monetary and fiscal policy.
Exactly. Monetary policy set by central banks, affecting interest rates, money supply, and fiscal policy, government spending and taxes shape the whole business environment. Lower rates might boost borrowing and growth, for instance.
While high inflation could hurt profits.
Correct. So understanding the economic outlook is crucial. Analysts forecast key things like GDP growth, inflation, interest rates, unemployment. They watch economic indicators closely.
And the stock market itself.
Interestingly, the stock market is often seen as a leading indicator for the economy. Stock prices tend to reflect what investors expect to happen in the future.
But it's not always perfectly aligned.
No. The source notes that market sentiment, investor psychology, short-term cash flows can cause deviations from the underlying economic reality sometimes.
Okay. Next, in EIC, industry or sector analysis. How does this help?
This helps you pinpoint which industries might do well or poorly, given the economic outlook. Different sectors perform differently depending on the business cycle.
Like cyclical versus defensive sectors.
Precisely. Cyclical sectors, think cars, construction, travel, are very sensitive to economic ups and downs. Defensive or non-cyclical sectors like utilities, consumer staples, basic food, household products, healthcare tend to be more stable. People need those things even in a recession.
So you might favor different sectors at different times.
Potentially, yes. Source gives examples.
Yeah.
Maybe finance recovers late in a recession, consumer durables pick up in recovery, while staples do better during the downturn. Inflation also hits industries differently based on their costs and pricing power.
And the industry life cycle.
Right, the source mentions that too. Industries often go through stages: introduction, growth, maturity, and eventually decline. Each stage offers different investment characteristics, risks, and opportunities.
Okay. And the final piece, company analysis.
This is the last step in that top-down approach. Once you've found attractive industries, you zero in on specific companies within them. Which ones are best placed to succeed?
Is this the same as valuation?
Not quite. Company analysis focuses more on the qualitative aspects, the business itself, its competitive advantages, management quality, strategy. Often uses SWOT analysis: strengths, weaknesses, opportunities, threats.
So assessing the business quality.
Yes, but critically, a great company isn't always a great investment if its stock price is too high. That's where valuation comes in. But company analysis tells you if it's a business worth valuing in the first place. Financial statement analysis, looking at the profit and loss, balance sheet, cash flow, and ratio analysis are key tools here too.
Got it. So after all that analysis, economy, industry, company, the next step is estimating intrinsic value. The source stresses price isn't value. Tell us more.
Yeah, that's such a crucial distinction. Price is what you pay in the market right now. It's a fact.
Yeah.
Value, intrinsic value, is what you think the stock is actually worth based on your deep analysis. It's an estimate, an opinion.
An informed opinion, hopefully.
Hopefully. That's why the source calls valuation both an art and a science. It uses quantitative models, yes, but also requires judgment, understanding the business context, future prospects.
And the goal is to compare your value estimate to the market price.
Exactly. Is the stock trading below your estimated value, undervalued, maybe a buy, above it, overvalued, maybe avoid or sell,
Yeah.
or around it, fairly valued?
The source mentions 3 valuation approaches, then focuses on relative valuation. What's the basic idea there?
Relative valuation is like comparison shopping for stocks. You value a company by comparing it to similar companies using standardized financial ratios or multiples.
So how does it stack up against its peers?
Pretty much. If similar companies in the same industry trade at, say, an average of 15 times their earnings, you'd expect the company you're looking at to trade somewhere around that multiple too, assuming its growth and risk are similar. It gives you a market-based benchmark. Is it cheap or expensive relative to others?
Okay, let's look at some key ratios. The PE ratio, price to earnings, is probably the most famous one. What does it tell us?
The PE ratio, calculated as stock price divided by earnings per share, EPS, tells you how much investors are willing to pay for $1 or 1 rupee of a company's earnings.
So a higher PE means investors expect more.
Often, yes. It can suggest higher growth expectations or maybe just that the stock is currently expensive relative to its earnings. The source mentions different PE types, trailing past earnings, forward, expected future earnings.
And you need context, right? Compare it to.
Absolutely. Compare it to the company's own history, to its industry peers, and to the overall market PE. But be careful comparing PEs across very different industries. A fast-growing tech firm might naturally have a higher PE than a slow-growing utility.
What about that example of a low-priced high PE stock versus a higher-priced lower PE one?
Right, the price itself doesn't tell the whole story. The low-priced stock might have very low earnings, making its PE high. You need to look at the underlying earnings and growth. Also, PE doesn't work well if earnings are negative. The ratio becomes meaningless.
Okay. Next, price to book value, PBV. What's book value?
Book value is basically the company's net worth, according to its accounting records, assets minus liabilities on the balance sheet, divided by the number of shares. The PBV ratio compares the market price to this accounting value.
So what does a low PBV suggest?
A PBV below 1 means the market values the company at less than its stated book value. This could mean it's undervalued or could signal financial problems. A PBV above 1 means the market values it higher than its books do.
Are there limitations?
Yes, a big one is that book value is based on historical cost accounting and might not reflect the true current value of assets, especially intangible ones like brand names or patents.
How do you calculate it properly?
You'd usually take total shareholders' equity, subtract things like preferred equity or certain miscellaneous assets, then divide by the number of common shares. The source notes PBV is often more useful for financial companies like banks, where assets are marked closer to market value.
Got it. Then the PS ratio, price to sales. When is this one handy?
The PS ratio compares market cap to total revenue. It's useful for companies that aren't profitable yet or have very thin margins because sales figures are generally seen as harder to manipulate than earnings.
So good for maybe young tech companies or turnaround situations?
Could be. Or just comparing companies in an industry where profitability varies a lot. A lower PS might suggest undervaluation relative to sales compared to peers.
What about the PEG ratio? That brings in growth.
Right, PEG stands for PE divided by the expected earnings growth rate. It tries to justify the PE ratio by factoring in growth.
How do you interpret it?
A common rule of thumb is that a PEG around 1 suggests fair value. The PE is kind of justified by the growth rate. Below 1 might suggest undervaluation relative to growth. Above 1 could signal overvaluation.
But it depends on accurate growth forecasts.
Hugely. And forecasting future growth is notoriously tricky. So the PEG is only as good as the growth estimate you put into it.
The source also mentions EVA and MVA briefly. What do they measure?
They're both about value creation. EVA, economic value added, is like the company's profit after accounting for the cost of all the capital it uses, both debt and equity. Positive EVA means it's generating real economic profit.
And MVA.
MVA, market value added, is the difference between the company's total market value and the total capital investors have put into it over time. Positive MVA means the market thinks the company has created value beyond the capital invested.
Okay. Then we get into ratios using enterprise value, like EBITEV and EVIBITA. What's enterprise value?
Enterprise value, or EV, is a broader measure of a company's total value.
Right.
Market cap plus debt minus cash. It's often seen as the theoretical takeover price
Why use EV in ratios?
because it allows for better comparisons between companies with different levels of debt, different capital structures. Ratios like EV/EBITDA are widely used, especially in M&A or for capital-intensive industries. EBITDA itself, earnings before interest, tax, depreciation, and amortization, is often used as a proxy for operating cash flow.
So EBITDA is useful even if a company isn't profitable at the net income level.
Yes, because it looks at earnings before interest and depreciation, which can be large non-cash expenses, especially for companies investing heavily in assets.
A few more. EVS, dividend yield, earnings yield.
EVS is just enterprise value divided by sales. Similar logic to PS, but includes debt via EV. Dividend yield is simple. Annual dividend per share divided by the stock price. Shown as a percentage, it's your return just from dividends.
Like that example, 5 dividend on 100 stock is 5% yield.
Exactly. And earnings yield is earnings per share divided by the stock price, also as a percentage. It's basically the inverse of the PE ratio and shows the earnings generated per rupee invested at the current price.
So for that Euro stock with 10 EPS, the earnings yield is 10%.
Correct.
And finally, the source stresses that different industries might favor different metrics.
Absolutely critical point. You don't use the same primary tool for every job. For stable cash flow businesses like consumer goods or pharma, DCF, discounted cash flow, might be key. For asset-heavy industries like cement or steel, maybe replacement cost is relevant. For banks, PBV is often central.
But PE is still common across the board.
Yes, PE is often used as a supplementary or sanity check metric almost everywhere,
Mm-hmm.
but you need to know the primary drivers and appropriate metrics for the specific industry you're analyzing.
Okay. The source then briefly talks about combining relative valuation and discounted cash flow models. How do they fit together?
Well, they seem different, right?
Right.
DCF tries to calculate intrinsic value from future cash flows, while relative valuation compares multiples to peers.
Yeah.
But the source points out they're actually related. The multiples used in relative valuation, like PE, are fundamentally driven by the same things that drive DCF models: growth expectations, risk, cash flow generation.
So a PE ratio is kind of a shorthand for a DCF calculation.
In a way, yes. It reflects the present value of future earnings. So both approaches are trying to assess underlying value, just using different lenses and techniques that can be complementary.
Right. Now, let's shift gears completely to technical analysis. This sounds very different from fundamentals.
It is a fundamentally different philosophy, yes.
Yeah.
Technical analysis basically ignores all that company-specific fundamental data we just talked about: earnings, management, industry trends.
So what does it look at?
It assumes that all that information, plus market psychology, is already reflected in the stock's price and trading volume. So technical analysts study historical price charts and volume patterns to try and predict future price movements.
Based on the idea that history repeats itself.
Largely, yes. They believe market psychology creates trends and patterns in prices that tend to recur and can be identified.
What are the key elements they focus on?
The source lists 3. Past price history itself to identify trends, trading volume to gauge the strength or conviction behind a trend, and the time span being analyzed, short-term versus long-term patterns.
What are the core assumptions behind this approach?
Well, things like prices are set by supply and demand. These forces include both rational and irrational factors. Prices move in trends that persist. These trends eventually change due to shifts in supply demand, and crucially, these shifts can be detected by looking at market action, meaning price and volume.
Critics sometimes say it's like reading tea leaves, just finding patterns in randomness.
That's a common criticism. Technical analysts would counter that while there's noise, collective human behavior in markets creates non-random patterns over time.
So the goal is different too, less about long-term value, more about timing.
Exactly. Fundamental analysis aims to find long-term value. Technical analysis is often used for shorter-term trading, trying to identify entry and exit points based on predicted price movements.
What's that saying about combining them?
You sometimes hear, use fundamentals to decide what to buy and technicals to decide when to buy. But the source, wisely I think, encourages focusing on long-term investing based on solid fundamentals for most people.
What advantages do technical analysts claim?
They argue it bypasses potentially flawed or manipulated financial data, focuses directly on market action, incorporates psychological factors, and can be quicker since you're analyzing charts, not digging through company reports.
Can you briefly explain a couple of the tools mentioned, like trend lines and moving averages?
Sure. Trend lines are simple. Draw a line connecting consecutive lows in an uptrend or consecutive highs in a downtrend on a price chart. They help visualize the trend and can act as potential support or resistance levels. Trend channels use parallel lines.
And moving averages.
They smooth out price data. You calculate the average price over a specific period, like 50 days or 200 days, and plot that average over time. It helps identify the underlying trend direction. Traders often look for crossovers, like when a short-term average crosses above a long-term one, as potential signals.
Bollinger Bands were also mentioned.
Right. Bollinger Bands take a moving average and plot two lines, or bands, above and below it, typically 2 standard deviations away. The bands widen when volatility is high and narrow when it's low,
How are they used?
often to identify potentially overbought conditions when price hits the upper band, or oversold conditions when price hits the lower band. It doesn't guarantee a reversal, but flags potential extremes.
Interesting that technicals can be used for bonds too.
Yes, the source notes that if you have a reliable price and volume data for an asset, whether it's a stock, bond, commodity, or currency, you can apply technical analysis principles to it. The underlying concepts about trends and patterns are considered universal by proponents.
Okay, finally, the source brings us back to something crucial. Qualitative evaluation of stocks. This isn't just about numbers.
Not at all. The qualitative side, the non-number factors, are arguably just as important, maybe even more so, for long-term success.
Like what specifically?
The source heavily emphasizes corporate governance. How well is the company run? What's the quality and integrity of the management team? Is the board independent and effective? Are their accounting practices transparent and conservative? Are they ethical?
Because governance failures can be catastrophic.
Absolutely. The source mentions fraud, scandals, excessive pay. These things can destroy shareholder value, even lead to bankruptcy, no matter how good the numbers looked on paper beforehand.
So you need to look beyond the spreadsheets.
Definitely. Understanding the company's culture, its long-term strategy, its competitive moat, the quality of its leadership. These qualitative factors are critical pieces of the puzzle.
Wow, that was an incredibly thorough walkthrough of the key ideas in those chapter excerpts. We've covered a lot of ground equity basics, risk, diversification, fundamental analysis, technical analysis, and these vital qualitative checks.
Yeah, we really dug into the core concepts. The aim was to provide that solid foundation based on your source material, demystifying some of the complexities of stock investing.
Absolutely. It feels much clearer now.
Good. Hopefully you now have a better handle on the essential principles.
So a final thought for you listening, as you digest all this. Think about that balance, the balance between fundamental analysis, understanding the why of a company's value, and maybe technical analysis, understanding the when of market timing. How might that balance align with your own investment goals, your own tolerance for risk, and how long you plan to invest? What kind of investor detective do you see yourself becoming?